Hello everyone, we are Group 5, the Innovators, and we're going to present the analysis of the spillover effect from the US equity market to Australian sectors. Our group includes Paul, Yusin, Jane, Fengwei, Rusin, and myself. Let's get started with introducing what we're presenting in the next 15 minutes. Firstly, we explain the research topic and different econometric models that are implemented in this research. Then, we demonstrate and interpret the generated empirical results, which are all finally summarized and qualitatively justified. So, what is our group researching on? We have raised a question, which is how was the US market volatility being transmitted to Australian consumer staple, consumer discretionary, and industrial sectors during 2015 to 2025? We aim to identify and analyze the influence of external shocks to these three sectors, and as a result, the spillover effect from the US was recorded with different magnitudes based on sectors and economic cycles. Now, I pass on Jane for the next part.
Building on the previous point, let me introduce our literature review that identifies two foundational references. First, Allen measures China's volatility spillovers to global markets. They found spillovers existed but weakened during a crisis, terming this a US phenomenon. Their method inspired our use of the Granger causality test. Next, was study on Australia cross-sector spillovers shows the total spillover index spiked to 90% during COVID-19. This paper provides our main methodological framework, the Diebold-Yilmaz spillover index. In short, study gave us a solid foundational from both international and sectoral perspectives. That's all what I have. And now I will hand it over to Stephanie.
Our data comes from Yahoo Finance, covering four indices: AXSJ for consumer staples, AXDJ for consumer discretionary, AXNJ for industrials, and the S&P 500 representing the US market. To divide the sample into different phases, we apply a wavelet-based cutoff method, which help us detect structural changes in the data. Specifically, we use the MODWT with a double sheath law 8 wavelet, followed by the PELT algorithm to identify the main cutoff points. As a result, we define three periods: pre pandemic, pandemic, and post pandemic. Now let's look at the EGARCH 11 model, proposed by Nelson in 1991. EGARCH stands for Exponential Generalized Autoregressive Conditional Heteroscedasticity. It is an econometric model designed to capture asymmetric volatility and leverage effects. That is, when negative shocks tend to increase volatility more strongly than positive ones. Mathematically, the model can be written as the formula shown on the slides. Here, alpha 1 measures the magnitude of past shocks. Beta captures volatility persistence, and gamma represent the leverage effect, showing how bad news affects volatility more than good news of the same size. In our report, the EGARCH model is used to estimate market volatility and spillover effects between the US index and Australian sectors. Compared to the standard GARCH model, EGARCH is better at modeling a symmetric and nonlinear volatility transmission, which help us understand how financial shocks spread across markets during different periods. That's on my part. Next, Hector will introduce more.
Thanks, Stephanie. Next, I will go through how we examine the interrelationships among sectoral volatilities using the Vector Autoregressive framework. This model captures the dynamic interdependence and feedback effects among multiple financial markets. In the VAR specification, each sector's volatility is expressed as a linear function of its own past values and the lagged volatilities of other sectors, thereby allowing us to trace the transmission of shocks across markets over time. The optimal lag length P is determined based on the AIC, which ensures an appropriate balance between model fit and parsimony. Consequently, the VR model serves as the empirical foundation for the subsequent Diebold-Yilmaz spillover framework, which quantifies the extent and direction of volatility transmission across sectors. And then we employ the forecast error variance decomposition proposed by Sims to measure how much of a sector's forecast error variance is explained by shocks from others. Using a 12-step ahead forecast horizon, we compute the DY spillover indices to assess the degree and direction of volatility transmission across markets. Four main indicators are derived. From others quantifies how much volatility a market receives from others. Two others measures how much it transmits to others. Net represents whether a market acts as a transmitter or a receiver. And total spillover index captures the overall level of market conductiveness. Together, these measures provide a comprehensive view of how volatility spillovers evolve across Australian and the US markets in different periods. In the next stage, we performed several diagnostic tests to ensure that our data met key statistical assumptions. First, the arch effect test by Eagle was used to examine whether volatility clustering exists in the residuals, and our results show significant arch effects, confirming that a gauge type model such as EGARCH11 is appropriate for modeling conditional volatility. Next, we ran the ADF and the KPSS tests on the difference log variance series, and all the results confirmed stationarity. This indicates that the volatility series are suitable for further analysis using VAR, Granger causality, and co-integration tests. That's all for my part, and I will pass it to Mikey for further techniques explaining.
Thanks, Hector. In this section, we use AIC and BIC to select the best log length for VAR model. Low AIC-BIC values indicate better model fit. Based on those criteria, we have selected log length for capture the spillover effects of fluctuations during different economic periods. Plus, we perform the Diebold test to test the serial correlation in the model residuals. A p-value greater than 0.05 suggests no serial correlation in the residuals, implying that the model fits well. Our test results show that there is no serial correlation in the residuals across all three periods. For the validating the robustness of the model, next Paul will represent the rest of the test.
Thank you, Mikey. After fitting the model, we further examined market relationships using the Granger causality and Johansen co-integration test. The Granger causality test extends the EGARCH11 model to capture volatility spillover, focusing on external shocks from the US market. The null hypothesis suggests no spillover effect, while the alternative, delta not equals to zero, indicates the presence of spillovers. Additionally, the Johansen co-integration test is used to assess long-term equilibrium among volatility sequences. The key result of the test determined by the rank of the co-integration matrix, showing R equals 0 indicating no co-integration, justifying the use of short-term VAR modeling. This approach ensures that the model captures both short-term dynamics and long-term relationships, improving the accuracy of volatility spillover analysis across economic cycles. Next, we further analyze this using the W matrix and the instant contemporaneous correlation test. The W matrix measures the adjustment after volatility shocks, where a positive coefficient indicates a shock transmitter and a negative coefficient indicates a shock absorber. This helps assess how markets respond to shocks. The instant contemporaneous correlation test captures same-day volatility co-movements. A significant result indicates instant transmissions of volatility, while a non-significant result suggests a delayed response. This enhances our understanding of volatility dynamics and market reactions. Moving on, we will be explaining the empirical result for each period. During the pre-COVID period, the laggard volatility from the US had a statistically significant impact at the 1% level on all three Australian sectors. As you can see from the first table, all p-values are less than 0.05 for the US effect on Australian markets. This indicates that past US volatility strongly predicts next day movement in Australian markets. The Johansen cointegration test confirmed that the US and Australian market share a strong long-run equilibrium relationship where any short-term deviations in volatility levels are corrected over time. The DY spillover analysis confirms a clear unidirectional volatility transmission from the US to Australian sectors, with all three sectors being net receivers of spillovers, at staples at 12.16%, discretionary at 10.11%, and industrials at 2.27%. While for COVID period, US volatility continues to significantly Granger cost the Australian market, with discretionary and industrial at 1% significance level, while staples at 10%. Discretionary and industrial were most sensitive to global shocks due to their exposure to international demand, while staples became more locally driven under domestic stimulus. Despite heightened uncertainty, all three statistics exceeded the 1% critical value, indicating that markets continue to move together structurally. Net spillovers dropped sharply for staple to 5.12% and discretionary to 6.84%, showing weaker US transmission during COVID period. Surprisingly, industrial became a net transmitter at positive 0.63%, which reflects its domestic production role during border closure. Lastly, for post-COVID period, US volatility again shows strong Granger causality on all Australian sectors, which confirms that US has re-emerged as the dominant volatility driver after the pandemic. The internal Australian links also suggest a revival of domestic sector interactions as economic recovery strengthened cross-sector activity. With all three statistics far exceeding 1% critical value, this indicates that the post-COVID period restored global equilibrium linkages. Net spillover analysis confirms that the Australian sectors remain net receivers of volatility, with discretionary absorbing the largest proportion due to its global consumption cycles at 20.09%, while the reduced magnitude for staple at 1.27% and industrial at 0.91% indicate greater domestic resilience. That is all from me, and I'll pass it on to Scarlett for the summary.
Thank you, Paul. And finally, we identified that each sector had different responses to the US volatility transmission due to its nature and the Australian government intervention. Consumer staple was a net receiver across 3 periods, but the spillover effect decreased over time, especially in period 3. It's mainly because of the defensive nature to be more domestically oriented. Likewise, consumer discretionary remained being a net receiver, but its uncertainty absorption boomed in the last period. The transition from a supported to a globally pressured environment made the sector become more volatile, reflecting a strong connection between the sector with consumer confidence and economic regimes. Finally, industrials showcase the most complicated sectoral pattern as it absorbed the volatility only in period 1 and 3, while transmitting uncertainty to the US during COVID-19. This is because of fiscal support and less fluctuated market conditions that stabilized the stock movement. Therefore, we can conclude that the spillover effect from the US equity market to three Australian sectors existed from 2015 to 2025. The finding is important as it helps investors to understand deeper the Australian market dynamics. And that is also the end of our presentation. Thank you for listening.